Hi everyone, I'm James Harte from Little Fish FX, and welcome to a special live market analysis session where we're going to be looking at the key themes and potential opportunities in the Forex markets over the final quarter of the year. But before we look ahead, let's just quickly recap the key themes that have dominated markets over the last few months to give us some context. So the summer months have been a particularly challenging time for FX markets, as many currencies essentially in a stalemate scenario as macro drivers dried up. The volatility which was expected to ensue on the back of Brexit didn't really materialize. The Bank of England refrained from initial easing, and following their subsequent easing in August, we have seen a series of increasingly positive UK data prints confounding initial bearish forecasts, thus keeping the bank sidelined in September, despite having warned in August of further easing to come. Similarly, the ECB, who had guided markets to expect easing in the wake of Brexit, stood to the sidelines as they highlighted positive data and downplayed initial Brexit impact. US rate hike expectations, which had been built around the Fed's initial projections of 4 hikes this year, deteriorated markedly heading into and over the course of the summer due to US data weakness and global uncertainty. Now, with the US elections ahead, the Fed remained on hold in September, noting their desire to wait for evidence of further progress towards their goals. Oil prices, which had been selling off steadily into the summer, rebounded and traded higher, fueling a rebound in risk appetite. So now, heading into the final quarter of the year, the battle lines are drawn around the key themes. So in terms of what we can expect to dominate the news flow over the final months of the year and the themes that we can look to position around, we have the following. So the first, of course, is Brexit. We have Brexit developments which have taken center stage. We then have the European banking crisis and geopolitical concerns, Fed hiking and US election, and then the issue of oil prices. So kicking off first of all with the hottest topic at the moment, which is of course the Brexit issue. Now, sterling has come under huge pressure recently following the confirmation by UK Prime Minister May that the UK will officially trigger Article 50 and thus begin the formal exit process from the EU by the end of March 2017 at the latest. Now, this confirmation has come as a big blow to many analysts who were expecting that the UK could avoid a hard Brexit and that some sort of compromise would be struck. So clarity now on the UK's exiting of the EU has renewed investor concern for the UK economy, and consequently, we've seen sterling sold heavily. Now, these moves in the UK currency come despite a spate of continued positive data, with PMI datasets specifically improving and beating expectations over each of the 3 months since the Brexit vote at the end of June. So the announcement has come a lot earlier than many market participants were expecting, and indeed markets have been somewhat caught offside here by this earlier announcement. Now, it's important to note that whilst the UK Prime Minister has now confirmed the timing of the UK's exit from the EU, the actual terms of the UK's departure are yet to be decided. Over the weekend, Prime Minister May noted that departure from the EU meant the UK would be in control of its own borders and that it should look to achieve the best possible deal in terms of single market access. So this suggests that the Prime Minister is willing to accept restriction to the single market in favor of controlling immigration, which of course is a key issue for many domestic voters. So this would, of course, entail a hard Brexit, which many analysts expect will be damaging to the UK economy as UK banks lose their passporting ability. However, there have been reports of increasing pushback within the cabinet, suggesting that perhaps a full hard Brexit can still be avoided. For now, however, the confirmation of the UK's departure is weighing heavily on sterling. So sterling is down over 15% now from the November 2015 highs, and this has actually aided the UK economy to some extent. We had BOE Deputy Governor Shafiq noting this week that the decline is certainly helping the economy to find a new equilibrium despite ongoing uncertainty regarding the UK's future trading arrangements with the EU. Now, the fall in sterling is certainly helpful in this regard and has boosted UK exports. However, the decline is also likely to translate into higher inflation in coming months due to higher import prices. So as mentioned there, the fall in sterling has improved the UK's current account deficit, which has improved to minus 5.9% in the second quarter of 2016 from minus 7% in the fourth quarter of 2015. However, further narrowing of the deficit is needed over the future period of vulnerability which the UK will experience between the triggering of Article 50 and the UK's formal exit from the EU. Now, with UK rates near zero and the room for fiscal impulse restricted by large government debt and budget deficit, a weaker sterling rate is definitely necessary, but not necessarily sufficient for providing stimulus to keep the economy on path. And if the UK government do pursue a hard Brexit, then they are going to need to be prepared to deal with much lower global purchasing power for as long as necessary to achieve the desired outcomes. Indeed, the fact that recent UK data has outperformed expectations and confounded forecasts doesn't alter the long-term risk profile. And BOE member Broadbent noted the difficulty in weighing near-term data prints against the longer-term outlook. So let's take a look at live chart table and discuss the technical landscape. And you can see we're in a really interesting period at the moment because we're breaking some truly historic levels now. You can see that we've broken down below the supporting trend line running from the 1993 and 2001 lows. We initially tested this trend line post-Brexit. We saw a small bounce. However, we have now since broken down below this level. Now, this level also holds the 78.6% retracement from the all-time lows in cable in 1985. So this is a really key technical level that we're currently challenging. And if price can sustain a proper breach of this level, then this of course opens up the path for much more downside in the pair. And the next key fib level is all the way down at 117.06. So a good 1,000 pips below market at the moment. Now, the break of this trend line can also be viewed as the break of a much bigger head and shoulders pattern. You can see we have the left shoulder over here around 1998. We have the head up here in 2007, and then we have the potential right shoulder here in 2014. So this is a classic bearish reversal pattern. And if we are indeed seeing the break of this neckline, then this does open up some very big targets in cable indeed. So we can see that if we map the last decline, which was seen during the 2007-2008 financial crisis, if we map that to the current move seen, that projects a move completing all the way down just below parity. However, of course, just below that level, we do have the all-time low in cable at 104.86. Let me just get rid of some of these lines so that's a bit clearer. So these are some very long-term levels to be looking at in cable. However, judging from the price action at the moment and the way the market is heading, these aren't far-fetched at all. And as you can see, the decline that we saw during the 2007-2008 period, if we see a decline of similar magnitude now, that will indeed take us down into a test of at least the all-time lows around 104.86 in cable. So again, some pretty big levels to be looking at. But for now, the price action is suggesting that we do continue lower, and it's going to take a significant rebound in cable at least break back above this 145 level to negate this medium to long-term bearishness. So whilst we hold below the 2001, 2008 lows, and indeed the initial 2016 lows, so if we go ahead and mark in our support level there, so whilst we hold below these levels, support levels, we're justified in targeting such low levels in cable, and these could be coming up in the next couple of months. So definitely key now to keep an eye on what happens over the next few weeks around this level. As I say, this is a key technical level for cable, and a break here potentially signals the break of a much broader neckline, the neckline of a much bigger head and shoulders pattern rather, opens up some much deeper targets. Now, moving on to the situation in Europe then. So the euro has been particularly stagnant over recent months as ECB easing expectations dwindled amidst a raft of positive data over the summer and neutrality from the bank during their July meeting. So many traders were expecting the ECB to announce further easing in July, or at least to tip their hand that further easing was likely to come. However, the bank stepped back from a lot of the forward guidance that they issued ahead of the Brexit vote, and downplayed the initial impact from Brexit. And so this really caused a reduction in ECB easing expectations, which supported the euro over the summer. However, events over the last few days and weeks, however, have prompted a bit of volatility to come back into the euro space, mainly driven by concerns for the European banking sector. Now, Germany's biggest bank, Deutsche Bank, is currently facing severe capital adequacy concerns relating to fines due to be applied by US regulators regarding to the mis-selling of mortgage-backed bonds by the German bank. Now, analysts worry that the bank will not have the capital to fulfill the fines and continue trading. And bearish sentiment has seen Deutsche Bank shares crashing lower, now down over 50% this year alone. German officials, importantly, are noted to be preparing an emergency rescue deal to backstop the bank if needed, including the prospect of the German government taking a 25% stake in the bank. European equities were, of course, rocked by these developments as banking sector stocks plunged. The main concern here is the level of contagion stemming from the bank, which has strong ties to the UK, France, and also the US. So these banking sector concerns are set to continue to plague the outlook for the euro over the next few months, before the euro area then faces more uncertainty by way of the Italian constitutional reform referendum to be held on December 4th. Now, the outcome of the referendum will have a significant impact on whether Prime Minister Renzi decides to stay in office. If the referendum is voted down and reform progress takes a step back, then political uncertainty is likely to increase. This referendum also comes just ahead of the French and German elections after the turn of the year, which adds even more risk to the euro outlook as we progress through Q4. However, it's important to note, though, that for now, the euro seems unperturbed by periods of risk-off activity. And again, this is likely to be a theme which we see develop over Q4. And the reasons for this are threefold. So firstly, there is much more ECB liquidity in the market than there has been in prior risk-off periods, such as 2012. There are a much wider range of operations and systems in play to provide support for the wider economy through easy access to liquidity, such as OMT, TLTRO, and QE programs. Alongside this, we have factors such as negative rates and excess deposits providing support also. And notably, the funding requirement for European banks is now much lower than it was in 2012 as a function of the lower operational requirements for USD funded balance sheets. Now, secondly, the reason why these Deutsche Bank concerns and broader worries for the European banking sector haven't translated into any protracted euro weakness is that despite the rhetoric and despite the media headlines, markets are highly skeptical that the German government would actually allow its biggest bank to fail, even in the event of significant losses being imposed on shareholders and creditors. And indeed, reports that the German government are preparing a rescue deal for Deutsche Bank have helped calm some of the concerns here. Finally, then, we have to look at the euro's role as a funding currency. Now, of key importance is the change in the euro's risk relationship since 2012. The eurozone economy now runs a large current account surplus, which increases excess liquidity, meaning that eurozone investors now typically provide rather than consume capital flow funding on a net basis. So this dynamic limits the eurozone's exposure to periods of risk aversion, and furthermore, acute situations that fuel repatriations tend to prove supportive for the single currency. So this is what we're tending to find where the euro is continuing to perform robustly during risk-off periods. Furthermore, then, this week reports that the ECB are considering tapering QE after the March 2017 end date have added further support for the single currency, which spiked over 100 pips higher on the news midweek. Indeed, if inflation rises over the coming months, perhaps fueled by higher energy prices, then the prospect of tapering is likely to take on a more central focus and provide further support for the euro. Now, obviously, we have the ECB October meeting in just under 2 weeks' time, and whilst the ECB are not expected to ease further at this juncture, traders will be keen to hear the bank's latest outlook and assessment in light of recent developments. Sorry. The press conference following the rates meeting is also likely to be particularly market moving, as Draghi is sure to be questioned on the situation with Deutsche Bank, updates with Brexit, and now also the prospect of QE tapering. So let's now take a look at the live charts then and see what the technical landscape is with the euro. So you can see that post-Brexit, we started to grind higher, and this was mainly the function of reduced US rate hike expectations in the wake of Brexit and subsequent investor uncertainty. However, over recent weeks, you can see that prices entered this really tight trading range, which has persisted from around the late August highs. Now, the key levels to point out here are the rising trend line from November 2015 lows and the bearish trend line from year-to-date highs, which give us this contracting triangle pattern within which price currently sits and indeed is moving deeper into the apex. So for now, it seems as though a topside break is the more likely candidate for a directional move for a number of reasons, really. So firstly, the ECB looks to be done now, or very nearly done, with easing. The neutral tone of their statements in recent months, alongside positive data prints and now talk of tapering of QE, doesn't suggest that the bank is likely to pursue further easing. One of the big reasons for this, according to ECB Chief Draghi himself, is that the risk reward on further rate cuts is poor, and evidence suggests that rate cuts are not affecting currency weakness anyway. And this, of course, is a theme which we've seen take center stage over this year, where many central banks have been frustrated by the disparity, with the disconnect in how currencies have reacted to rate cuts, where we've seen many currencies actually strengthening in response to central bank rate cuts. Now, furthermore, in terms of the global picture, there is a need for a weaker US dollar to help stimulate growth and reduce financial stress. So with this in mind, it seems that even if the Fed does hike this year, it is unlikely to start a cycle of dollar bullishness. Unlike last year, when the Fed hiked in December and the market was expecting 2 to 4 hikes this year, the Fed is now only projecting 2 hikes next year, down from 3 originally, and this is likely to be subject to downward revisions also. So ultimately, a hike this year would likely be a dovish hike from which the US dollar would trade lower. Now, of course, there are clear risks to this outlook, with much political and banking risk in the offing for the Eurozone. However, it is worth noting that over similar periods of risk over the last few years, Euro downside bets have proved futile due to the dynamics we were discussing a few minutes ago. So the situation with the euro at the moment is that we simply remain within this contracting triangle pattern. We have local structural support at the 111.20 level. So if we get a downside break of the recent low, the late August low and the September low, you can see that we also have this rising trend line support coming at the level also. So this could be a good breakdown level for the euro. And if we break down below this area, we could then look for a retest and a hold to confirm the downside move. Alternatively, if we do manage to break out above the bearish trendline resistance, then that opens up a topside move. And the first key resistance to the top side is going to be around the 114 level, which has been a really key resistance level for the euro over the last 2 years. You can see that on several occasions, the euro achieved a clear reversal from a test of that level. And oftentimes what we actually saw was a lot of ECB dovish rhetoric, or indeed ECB easing as euro dollar moved up into that level. So it could be that this is a clear reference level for the ECB. So if we do break out above the bearish trendline resistance, then the area to target is going to be a move up into this 114 level. And that really is going to be a key price pivot for the euro in terms of establishing direction over the next few months. So moving on then to the US dollar and the situation with the US at the moment. And the first issue to note, of course, is Friday's US employment reports, which will be the first labor market reading since the September FOMC. And these will take prime importance. So consensus forecasts are calling for a strong print at 170,000 versus last month's 151,000. Now, if the NFPs can print in line with these expectations, then US rate hike expectations are likely to get a shot in the arm, and we can expect some decent US dollar upside, leading the euro lower. Now, going back to the live chart quickly, as we stated, the key levels to look for on any break lower will, of course, be this 111.20 zone. So we have key local structural support and key rising trendline support. So if we do make a break of that level, that could suggest a signal, rather, a deeper test coming down to this support at 109.60, which was around the June and July lows. Now, alternatively, if the non-farm payrolls once again fail to meet expectations, then the US dollar is likely to come under significant pressure. Again, the Fed reiterated their data-dependent stance at their recent meeting, and also the need for further strengthening in the labor market. So a weak print at this juncture is likely to fuel sustained US dollar selling as rate hike expectations once again tumble. Now, despite a raft of positive Fed commentary during the last Fed speaking cycle, which saw many members espousing hawkish sentiment, the data is still not supporting a rate hike at this juncture. And the disconnect has been responsible for the stagnant price action, which we've seen over recent months. And again, if we just go back to that euro chart, you can see, if we go out to the monthly picture, just how gridlocked price action has been. You can see that for the last 4 months, we've simply been trading with inside the range set in June rather. So you can see we've spent 4 months trading with inside the range of the June monthly candle. So price action has become particularly contracted at this point amidst a lack of clear directional drivers. So the market has been trying to get behind the idea of a US rate hike. We've seen upticks on positive US data and in response to any hawkish Fed commentary, but continued underperformance on key data sets has significantly hampered the hawkish argument. Now this week, it's important to note that we have seen a slightly firmer US dollar across the board, which suggests that some of the risk premium priced into the greenback ahead of the US elections has been taken out to reflect the strengthening of Clinton's lead in the wake of the first debate, which saw her dominating her Republican counterpart. So the lower probability of a Trump presidency can clearly be seen in the US dollar against the peso. So you can see here that the dollar has weakened against the peso, making it back below those pre-debate highs. And the peso has largely been used as a barometer for the Clinton-Trump skew, with Trump dominance affecting a weaker Mexican peso, as his proposed policies, which include strict restrictions on Mexican trade and immigration, are expected to significantly weaken the currency. For now, though, you can see, as we say, that the peso has rebounded and made a slight recovery against the US dollar, which has now fallen back to below those pre-debate highs. Now, also responsible for the current rebound which we've seen in the US dollar. So if we pull up the dollar index chart, you can see that we are still currently trapped between these two key levels. So we have the bearish trendline resistance from last year's highs, and then we currently have this corrective bullish channel. And we are now traveling into the apex of a contracting triangle. But the US dollar has continued to strengthen this week, as we've seen a little bit of positivity in key data prints. So we had a rebound in the US ISM manufacturing index on Monday, which beat expectations to print 51.5 on the month in September versus 50.4 expected. And then yesterday, we saw a similar rebound in the ISM non-manufacturing index, which printed 57.1 versus 53 expected. So two solid prints there in these leading indicators. And as you can see, the US dollar is currently enjoying some upside. However, we are just shy of testing this key resistance level. And of course, the next clear catalyst is going to be the US employment reports on Friday. So it's going to be key to markets to see what this data comes in at in terms of establishing next steps for the US dollar. Now, in terms of looking ahead over the first half of the last quarter of the year, the key driver for the US dollar over these next 6 weeks is going to be the development of the US elections. If Clinton can continue to carve out a stronger lead in the polls, then the US dollar is likely to remain supported, indeed keeping that dollar-yen base at 100 intact. So you can see, just looking at the dollar-yen chart, that the key 100 level, which has been tested several times now post-Brexit, has failed to give way. And indeed, this latest bout of US dollar strength has taken the US dollar through the bearish trendline resistance, which has capped price over the last several months. So this is a key rebound in the US dollar. And again, the employment reports on Friday are going to be the next clear list for a directional move. So if Clinton can continue to carve out a stronger lead in the polls, then the US dollar is likely to remain supported, keeping that base at 100 intact against the Japanese yen. Now, similarly, the reduction of risk in response to a Clinton lead and the likelihood of a Clinton presidency should continue to weigh on the Japanese yen amidst a reduction in safe haven inflows, creating scope for a higher path in the dollar yen. The next key event to watch for in terms of the elections then will be the next debate, which is to be held on the 9th of October. And if Clinton can once again dominate the proceedings, then we can expect the USD to continue to follow through higher. Looking ahead then to the second half of the quarter and the dollar response to the election results. Again, Clinton win will be seen as a mild positive for the US dollar and for risk sentiment too, avoiding the more extreme policies and general unpredictability of Trump. Now, this should allow the Fed scope to tighten rates if it judges the data to be firm enough. So again, key is the Fed's data-dependent stance. So if US election uncertainty can be avoided and Clinton is elected, then this will create a more stable environment for the Fed to raise rates, again, provided that they judge the data as being supportive. Now, on the flip side, a Trump election is likely to keep the Fed sidelined, as we can expect heightened uncertainty and general risk-off trading to impact markets and investor sentiment negatively, and the Fed is not likely to look to add to those conditions by raising rates. So, two key elements to keep an eye on here in terms of the US dollar: the election developments and results, and then also economic data over the next few months. And again, going back to that dollar index chart, you can see that we are approaching a very key level now. So either this corrective bullish channel is going to continue and we're going to break out above the bearish trendline resistance and travel higher, or this bearish trendline resistance is going to hold and we're going to see the break of this corrective bullish channel, which could indeed be a bear flag at this juncture and a rebound down to those lows around the 92 mark. So the final theme then, which we need to consider heading into the final quarter, over the final quarter of the year rather, is that of oil prices. So the informal OPEC meeting, which took place last week, markets were taken by surprise on news that the group had agreed a production freeze. The finer details are set to be discussed at the upcoming OPEC meeting in November, but the initial market reaction to the news has been a steady surge in demand for oil. Now, this demand was further increased this week as Iran called upon non-OPEC members to support the market by agreeing to production cuts and thus boosting the price of oil. These remarks by Iran have helped assuage investor skepticism in the wake of the news last week of a production cut agreement. Now, looking at the technical picture for oil then, and this again supports the idea of higher prices. You can see that we potentially have a large inverse head and shoulders pattern here, with the left shoulder in August 2015, the head down here in February of this year, and then the right shoulder in August of this year. So the neckline of this pattern is going to be a key price pivot for oil at around the 51.70, 51.80s area. So essentially, if price can make a sustained break of this level, then we can assume that the inverse head and shoulders pattern is in play and then look to set longs. Now, the target on any long trades that we can look to get into on a breakout above that level should be the ABCD move here. So you can see we have these two equidistant swings which complete into the roughly late 64 level, so 64.93 there. So this symmetry in the market presents a good target level. However, just ahead of that level, you can see that we do in fact have the 2015 highs at around the 60T60s level. So this is likely to be an area of interest to sellers. And so any longs that are set on the break of this 51.70 level should look to be exited price action dependent into a test of the 2015 highs. Now, we also have clear bullish channel resistance at that point. So you can see we have the bullish supporting trend line here, and then the resisting trend line here. So if we do make a move up into this level, we have good technical resistance there, which could present some short-term stalling for oil. However, if we fall back from that level, we can then look to trade a retest of this broken neckline to position for more medium to long-term strength in oil. And indeed, we have further confluence at that level, further support at that level rather, with this symmetry confluence. Again, we have the broken neckline retest, and then we also have the rising bullish channel support. So if we do stall at a test of the 2015 highs and fall back, then this could be a good level to look to get long. So really, if we think about the different elements that we've discussed here, we've outlined a base case scenario, which is for oil prices to rise, taking euro higher also, whilst the US dollar weakens. Now, if we do see these higher oil prices materialize, then this is going to have significant consequences also for the commodity currencies. And you can see, looking at the Australian dollar at the moment, that we've again formed another similar contracting triangle pattern within a larger bullish channel. So this bearish trendline resistance here is a key price pivot for the Aussie, and potentially driven by higher oil prices, we could see the Aussie breaking out above this level and continuing its path in the bullish channel. So if we do make a break higher, then we can at least look for a move up to around the 81.48 level, which again gives us this symmetry swing here and takes us into the 2015 highs, which are likely to provide decent resistance. So we've got some good levels to look at here on the Aussie. Again, the topside break here has a little more room and looks to be the clearer candidate for a move, but obviously dependent on what we see with the US dollar over the next few weeks and months, and again, oil prices. So in terms of the base case scenario that we've discussed, there are obviously a lot of risks to this, and the themes that we're discussing are particularly dynamic. So it's important to keep an eye on developments and news events as we move through the quarter. And indeed, we'll update this analysis in the upcoming sessions that we have. So I hope that's been useful, and you've got a clear idea now of the sort of themes that we need to keep an eye on and the technical setups that we also need to keep an eye on over the next few weeks. Now, in the meantime, please head to the website www.littlefishfx.com, where you can check out all of the great educational material we have, as well as our daily Forex trade alerts, which are up over 3,100 pips since November last year. We just closed out another plus 100 pips in September. And we've also recently launched our Pro Trader package, which gives you access to our daily Forex trade alerts, as well as access to live weekly strategy sessions with our Little Fish traders. If you're interested in those trade alerts, then please use the gratitude coupon here, LFX Street 16, for 10% off those. And in the meantime, good luck and take care, and I'll catch up with you all next time. Thanks.